Welcome to Urban Green Live. I'm your guest host, Ellen Honigstock, Director of Education for Urban Green. This is a program series where we interview global experts to better understand how we get to a zero carbon future. And you get to participate too, because we'll have live Q&A in just a bit. Tonight, we're turning the tables, and I'm interviewing our regular program host, John Mandyck, our CEO, about the implications of carbon disclosure in the financial industry. In addition to being Urban Green's CEO, John is also an adjunct professor for sustainability and ESG at the University of Connecticut and a 25-year corporate veteran, retiring as Chief Sustainability Officer for United Technologies Corporation, one of the world's largest companies. 3.5 weeks ago, John published an article in Harvard Business Review exploring the impact of carbon disclosure by banks. So today we're going to follow the money. John, welcome to the program, and this time in the guest seat.
I know, Ellen.
Are you ready?
I'm a little nervous on this side, but I'm ready.
I'm glad to hear that you're a normal person. Okay. First, why did you write the article for Harvard Business Review?
Well, you know, carbon disclosure is such a big issue, and few people are starting to understand the implications of it. And the implications in the financial industry are even more interesting and more pervasive. And so actually, a couple of friends of mine prodded me to do it. And it's really meant to increase the public dialogue on why carbon disclosure can be so transformative for sustainability, for the built environment, for climate change overall. You know, I think we'll look back in 2030, we will look back at 2022 and we'll say, can you imagine in 2022, we didn't know the carbon emissions of companies?
Right.
I mean, if you're investing in a company, you know the sales,
right?
You know the profits. Why shouldn't you know what the carbon emissions are? And this is the beginning of that dialogue. I think when we look back, 2020s will be the decade of disclosure when it comes to carbon emissions.
Oh, that's interesting. So why is the SEC proposing this rule?
Well, I think the SEC is trying to give more data to investors. We're approaching $40 trillion of funds under ESG management or ESG funds. So when investors go to put their money in the marketplace, $40 trillion is going into ESG funds. And Bloomberg says it's on its way to 50 trillion in just by 2025, which would mean a third of all investments in the world under management would be in ESG funds. So it's a question of, are investors getting what they're buying? Right. How do they really know? So there are some ESG rating companies and they're out there, but truly you don't know unless the companies are disclosing what their risks are and what their emissions are. And that's what the SEC rule would do, is it would require publicly traded companies to disclose their climate emissions and their climate risks. But that's the investor angle, but there's an angle for you and me and everybody else watching, right? One, we could be investors, right? So if we have a 401k fund, wouldn't you want to know what the carbon profile is of the options you have to choose when you click on your 401k? So there's an implication there. But when it comes to banks, there's another really interesting implication. Like we get a paycheck, it goes into a bank. We think it sits there, and like when we want it, we go to the ATM, we get our money out, right? In reality, it doesn't work that way. The banks take your money, my money, everybody watching, they take all of our money and they pool it and they make loans, right? We don't know where that money goes, but they make loans. Well, it could be that we work all day to fight climate change, and at night our money is used to fund oil exploration.
Right.
And we just don't know that. And it's our money. And so this would be part of that disclosure, particularly for banks, publicly traded banks, to start to disclose what are the climate impacts of your loans and what are the emissions that are generating it, so we can start to make better informed decisions.
Okay, so give us some detail on how would the SEC rule work?
So the SEC would require publicly traded companies to disclose scope 1, 2, and 3 climate emissions. So let's just break that down for a minute. Scope 1 climate emission, let's take a manufacturing company. A scope 1 climate emission for a manufacturing company would be fossil fuels burned on site. So if you're running a factory and you have processes that are run by natural gas and you're burning it on site, that's scope 1. Scope 2 would be the electricity or the power that's purchased typically from a utility. So that's scope 2. And then scope 3 is basically everything else, which is huge. For a manufacturing company, it could be 80% of their emissions. So scope 3 would be all the carbon impacts of the raw materials from the supply chain, and then all the carbon impacts of the products and service, whatever that manufacturer makes products and use. That's scope 3. What the SEC rule says is that companies, publicly traded companies, would now have to disclose scope 1, 2, and 3 emissions, and also disclose climate risks. But it's that by disclosing those emissions, which aren't required today, some companies publicly report them. Problem is some report scope 1, but not scope 2, scope 1 and 2, but not scope 3. And so it's not apples to apples. So we get this uniformity on disclosure. Now, when it comes to a bank, it gets really interesting. So if you're a bank, your scope 1 emission is maybe the boiler in your basement, heating the bank. Scope 2 is the electricity you buy from Con Ed. But scope 3 for a bank are the loans. That's the product of a bank.
Okay.
And so that's why this is so transformative, because this law, if it becomes law, this proposal, if it becomes law, would require banks to disclose the climate impacts of their loans.
Okay, I'm going to back up a tiny bit.
Mm-hmm.
We have a question from the audience. What's an ESG fund?
ESG fund. So ESG is environmental social governance. It is the way that investors think about companies. So when investors want to look at a company, they want to look at their ESG profile, which means, are you doing good for people? Are you doing good for the planet? And are you a well-run company from a governance standpoint? Do you have ethics programs, et cetera? There are funds on the market today that specialize in investing in companies that have higher of these ESG ratings, right? So if you have a high ESG rating, you go into one of these funds, and then you can invest in it. The issue is the data is imperfect, right? So some of those companies and those ESG funds disclose climate emissions and risks, some don't. The difference here is that this law, if it becomes law, this proposal, if it becomes law, would require all those companies to disclose their climate emissions. So then you can actually make a determination on, is this a climate leaning forward company or not?
And I'm asking a follow-up question here. So would they be required to disclose in the same way so that you compare across the board? And who verifies that they've included it all?
Yeah, these are good questions to be worked out. Yes, the beauty of the SEC proposal is declare scope 1, 2, and 3 emissions. Those are quantifiable.
Okay.
Not as easy in scope 3. Scope 1 and 2, very easy. You just look at your utility bills, basically. But yes, it would require every company to do that. The issue with scope 3 is it's enormous, right? For a manufacturing company who could have thousands and thousands of suppliers and then millions of products in use, right? So it's hard, I get it, but the impacts of climate change are harder.
Yeah.
And so we have to figure it out.
Okay, I'm gonna come back to that later. All right. Why does the SEC rule have global implications? Is this a national thing, global?
Yeah, so this is a proposal by the U.S. Securities and Exchange Commission. So it covers U.S. publicly traded companies. In the context of a bank, though, again, it's very interesting. Most of our banks in the United States, our biggest ones, are publicly traded companies. They would be covered. But U.S. banks loan to private companies. U.S. banks loan to international companies. And so by covering U.S. banks, you, in a really interesting way, cover the global economy, because the bank is using its money to finance the rest of the world, and therefore they would have to account for the emissions associated with that financing.
That's so interesting. Okay, so this is not a law yet. Is it realistic that the proposal will become law? And what if it doesn't? Could this kind of disclosure requirement happen a different way?
Well, it is the SEC is taking comment on it. It's a proposed regulation right now. A couple of things to that are important here. One, the SEC has the ball. It's their authority to decide whether to do this or not. They don't need to ask Congress for permission. This is their authority. So if the SEC wants to do this, they have the authority to do it. Now, it's getting a lot of opposition. And I would say companies that are opposing it are really worried about their own exposure versus what it means for the global economy. Because while it may be difficult for a company to do, it may open a whole new market for them that they're not thinking about. So if you're in the energy efficiency business and you make a product that uses less energy, yes, you're going to have to disclose more as a company, and that a company may be thinking, well, this is too hard. Why do I want to do this? But if it doubles, triples, quadruples the energy efficiency market, because now banks will want to invest in energy efficient things, not energy inefficient things, it may have a longer term impact for an industry or for a business. So the SEC has the ball. We'll have to see what they do. We should know this year whether they're going to make it final or not. If they don't, I think the horse is out of the barn. Investors understand that climate risk is investment risk. Like investors know, like if I'm going to be putting $50 trillion on the line, I really need to know what your climate emissions are.
Right.
XYZ company. And so I think investors more and more are going to demand this. I think there could be banks who want to get ahead of the curve who voluntarily decide to do this. And
Are there any banks that are already disclosing in that way?
Not as comprehensively as the SEC that I'm aware of, that the SEC would require. But all you need is one to do it. And I think it would bring the rest of the industry in. And then the third thing to keep in mind is it's pretty clear that Europe is going to require this. So that if you're a publicly traded company in Europe, you're going to have to disclose your emissions. And the same banks operate there, right? So it's a global industry.
Right.
And so if they have to do it in Europe, they may decide they're going to do it everywhere. So yes, we'll have to see if the SEC law is finalized, and even if it's finalized, if it's challenged in court. But I actually think the ball has now started to roll down the hill, and it's going to be hard to stop it.
Interesting. I want to ask about timing. Let's say this law goes into effect this year, this rule.
Mm-hmm.
How long do you think before we would start to see the first reports?
Yeah, so that's part of the give and take with the SEC comment period. I think the SEC wants companies to start reporting in the next 2-3 years. That might be ambitious. Some may be ready to do it. Some may not. I mean, it's not easy, right? It can be done, but it's not easy. So particularly in the scope 3 area.
Right.
And so we need better data systems. We need better data mining systems. And frankly, we probably need some modeling systems to help companies understand how do you model what your scope 3 emission might be.
Thank you. I'm just going to remind our audience, if you have questions, just send them in. Feel free to interrupt us. I'll ask John anything. Okay. I'm curious, what is the impact to buildings and policies like Local Law 97?
I think this could be huge for Local Law 97 because the number one thing banks provide loans to is real estate.
Oh, I see. Right.
Right.
Oh,
and so now if a bank has to disclose the impact of the carbon emissions of its loans, de facto, they're going to be disclosing building emissions in their portfolio.
Right.
And once you do that, there's going to be a bank that's going to say, I'm either better or I'm going to be better. And I want to be better because I want to drive investment to my bank from investors.
Right.
So all of a sudden, banks are going to be really interested in the energy efficiency and carbon profile of buildings in a way that they're not today. They're kind of agnostic. Like banks know what Local Law 97 is, but they only care for their own property.
Right.
They don't care for
it doesn't extend beyond their borders.
They don't care for all the loans they're providing. Right. This proposal, if it becomes law, will now directly link banks to building emissions. And I think it could unlock a whole new suite of bank products for retrofits. So there could be better terms for building retrofits. Or put a different way, there could be a Brown premium for inefficient buildings.
Right. To jumpstart the retrofit work.
Right.
That's really
Or
interesting.
even to bring it down to the individual level, you could easily see banks for people who are doing personal mortgages on a home or wherever they live.
Mhm.
The bank is going to want to know what the carbon profile of that property is. And so I think what this SEC proposal could do is it could make carbon emissions as important as your credit risk.
Interesting. Oh, it's very interesting. All right. So carbon disclosure is a big part of the global net zero movement, but there's a lot of confusion about what that actually is, right? So can you help us break that down?
Yeah, so net zero means a lot of things to a lot of people. I think that's part of the problem. And a lot of people are disclosing that I'm net zero, you're net zero, we're all net zero, when they all have different ideas of what that means. It's if I root it back in the Paris Climate Agreement. So the Paris Climate Agreement is basically a net zero agreement. And what it says is we have to have carbon emissions by 2050 and then have them again by 2050. So I'm sorry, have them by 2030 and then have them again by 2050, 2 steps, which means like you got to really bring down carbon emissions. But there's a recognition that even when we do that in 2050, we're still going to be emitting some carbon. What net zero means is in 2050, whatever we emit, we have to take out of the air. We literally have to remove that carbon from the air. That's the net part. Right?
Okay.
So that's what net zero means as a concept. And it sounds crazy, like removing carbon from the air. It's not freak science, right? So
Right.
I had a seltzer water for lunch today. I'm a professional in this field, and it like hit me like a ton of bricks like last year when I was reading the bottle, like kind of just coincidentally. It's carbonated water for a reason. There is carbon in the water. There's CO2 in the water. So we capture CO2. We use it for carbonation. We use it for greenhouses. So it's not like we don't know how to do it. We do. We don't quite know how to do it at scale yet.
Right.
But we will. And that's why the carbon removal technologies are so important and intrinsically linked to what net zero is.
And that's on an operational level. So every year, 2051, whatever's left in that carbon budget would need to be removed from the air.
Correct. And there's a pilot plant running, I think it's called Orca in Iceland, which is just this giant plant with these big fans that are sucking CO2 out of the air. Now, the thing is, there's 2 steps to this, really. Like you have to remove it from the air, but then you got to figure out what you're going to do with it, right? And so you have to sequester it and do something with it so that it doesn't re-emit itself. And there are lots of ways you can sequester carbon too.
Right. And we have a little bit of time to make that better.
Right.
All right. So we've seen a lot of companies declare net zero goals. Is there a standard that they're following or that they should follow? There
hasn't been, and there is a new standard developing. It's called the SBTI, Standard Science-Based Targets Initiatives. And this standard was developed with SBTI, with the United Nations, with the World Wildlife Fund, and with the World Resources Institute. So these are the big thinkers behind sustainability. And it's meant exactly to do that, to say, okay, if you're net zero, then like there is a standard you have to certify to, which includes bringing down your emissions as much as you can. Like you can't offset everything. That the criticism in the corporate world of net zero is it's too much net, not enough zero. Everybody's buying offsets. Right. And so to declare yourself net zero to the standard, you have to do the hard work to reduce your profile. And then you have to commit at the end, like the Paris Climate Accord does, that you have to invest in removal technology. So today we buy RECs, renewable energy credits, to help jumpstart the renewable industry.
Right.
In 2050, we'll be buying a REC type product to remove carbon from the air. It'll be investing in technologies that remove carbon from the air.
Okay, well, we're going to come back to that too. However, before we open up to audience questions, and I encourage you, there's a few questions, we want more. We had a big conference last week. It went very well, if I do say so myself. We had, 400 people. What surprised you the most? What did you hear that surprised you?
Well, our conference was about electrification. I still can't say
It's
it.
the worst.
Electrification to
was your idea.
electrification. Electrification. There are a lot of electrifictions out there that we busted. So I think what surprised me the most about the conference were, the last time we had this discussion a few years ago at a conference, it was much more theoretical about what if and why not. This conference was much more practical. It was like, in just a short period of time, there's been this change of, I would say, attitude about like, are we going to do electrification to, no, we are going to electrify. And now here are the issues associated with it. So it's not about if now, it's about when. And then all the things that come with the when, the financing, everything else that's needed. But I think that was the biggest surprise, is just the tenor of the conversation is different.
That's very interesting. Okay, well, thank you for your questions. We're going to turn to those. Are you ready?
Yeah, sure.
Okay. Have any banks indicated that they're on board for this kind of emissions disclosure? Like,
I haven't seen it yet. I haven't been combing to find out either. I know some are very concerned about how do they measure this, like everybody else. Like if you have to disclose scope 3, it's hard.
right.
But just because it's hard doesn't mean we shouldn't do it.
Right.
And sticking our head in the sand with climate change has gotten us to where we are right now. And so I think this level of transparency is what's really needed to change the marketplace so that we know what's going on. It's like crazy to me that we don't know what the carbon emissions are of companies, right? And what's even crazier is many of them don't know because they're not measuring it.
Right, exactly. And what you don't measure. All right, so this is an interesting question. How do you think the SEC will handle the double counting that will occur when both an industry and the bank that lent them money report the same emissions?
Yeah, it's a great question. There is a lot of double counting because if you think about it, just by definition, everybody's scope 3 is somebody's scope 1.
Right. How does that work?
So it doesn't matter because risk is risk. So remember, this is about understanding risk, investment risk, and how you measure a company. So this isn't about a standard to get us to meet some climate change target, right? Because you're right, there is a bunch of double counting. This would be a requirement or a proposal that would allow us to understand what is the carbon profile of a company, and is that a company I want to invest in? Or is that a bank I want to give my money to at night, knowing where my money is being used to finance? Is my money being used to finance oil drilling? Is my money being used to finance deforestation in the Amazon? Because let me just tell you, loans are made every day that lead to those consequences, using somebody's money that they don't know. And I think corporate America is also going to wake up to this because Ellen, you and I will make a big impact for the money we have in the bank, but like when Google's money's in the bank,
right,
or some of the world's largest companies' monies are in the bank, their treasuries are in the bank, I think they're going to want to understand what's happening with their money, because I've seen some estimates that show some of these companies could double their carbon profile if they had to account for how much money in the bank that they have is financing other carbon emissions. Right. And so transparency is the key here.
Right. Okay. So this is a complicatedly worded question, but I think it's a good question. Hopefully I'm going to read it properly. Would you ever foresee global carbon emissions reports following this corporate greenhouse gas protocol? For example, countries accounting for outsourced manufacturing emissions?
Yeah, it's a good question. Let me come at it from a different perspective, and then we'll come back to it directly. Is if the Paris Climate Accord is net zero, everything has to be, right? So if the global regulatory regime is a net zero regime, right, then a country that signs up for it is, by definition, signing up for a net zero regime, right? And if you're a company in that country that's signing up for a global net zero regime, you need to ladder up to it, right?
Yeah.
And so we need to get uniformity in the way that we look at it, and it's very choppy. I have to tell you that the net zero approach is taking hold outside of the United States, not inside the United States, particularly in Europe. And so we're kind of late to the party on what net zero means, and I think we're going to have to get there quickly if we're going to make the Paris Climate Accord work. So yes, that's a long way to answer a question like this, but yes, you know, a country needs to account for those emissions too. You know, where and how the emissions happen is all part of how you think through signing up for net zero.
Interesting. Okay. If I had the same question, if this moves forward, do you have any speculation as to how the scope 3 reporting would be standardized and verified?
Yeah, so we're going to need that.
Like, but who would do it? Like, where would that come from?
You know, I think we'll see standards develop for it, frankly, because we're going to need it. It's interesting. Net zero is kind of where the green building movement was 30 years ago. So I had the good fortune of being around then as the green building movement started. And it's not an exaggeration, and some of our longer term members will remember this, that people were painting walls green and calling buildings green buildings. And there was no way to tell what one building was versus another. That's why the LEED rating system was created, was to help to define, measure, and certify what green buildings really are in this country and around the world. And so now we have a common language, at least with that standard, on how to think through what a green building is. We don't have that with net zero yet until this SBTI standard came up, because every company was approaching net zero a different way. Some were disclosing scope 1 and 2, but not 3. Now we have the standard that'll help us think through that.
So does the SBTI standard supersede other standards, or are there other standards that
there are many standards out there? Even Amazon's trying to create their own standard that I've seen that companies are looking at. Net zero, I would say the SBTI net zero standard, though, is like the gold standard because it has the United Nations backing behind it.
Okay.
And it has the world's most trusted environmental groups behind it. And so I think that's the one that's going to win out. And by the way, that one you do have to verify. Like, you have to go through a verification process with SBTI to be certified.
Can you tell us a little bit more about that verification process?
Yeah, you have to submit your data, and a third party looks at it and does an audit of sorts to understand if this is real or not. But if you get back to who's going to verify, who's going to do this, we're probably not unlike where we were 100 years ago when we made companies, release their sales. Like, how are you going to count that? How are you going to know it's real? What standards? How are you going to verify it, right? And a whole financial accounting industry was born to do just that. And that's complicated.
Right.
Talk about double counting, make sure there's no double counting, right? So we've done this.
Okay.
Right now, we just need to do it with a different unit. We've already done it with dollars, and we've mastered it. Nobody questions that anymore, right? Now we just need to do it with a different unit, which is carbon, and develop what is the standard accounting system, what is the standard audit system, so we can, get to the same level of transparency we have on financials that we would with emissions.
Now, how does the standard treat embodied carbon versus operational carbon, or is that just a difference between the various scoping?
Yeah, it would be in those scopes.
Okay, and so like something way down on the supply chain, scope 1 rolls itself up as scope 3 to one of these larger companies.
Yes,
okay,
exactly.
Okay. So another question we received: the SEC guidance also includes disclosing climate risks. So what are climate risks, and are they separate from carbon, and what can we learn from this type of disclosure?
Right. So the risks is interesting. The risk reporting is a little bit more my interpretation of it anecdotal. So like you literally list your risks, right? So your risks could be all of my factories are in low level areas in hurricane zones. Investors may want to know that. So that's a risk. Another risk could be all of my supply chain is in a hurricane zone. So that's a risk. So, it's just what is the risk? And there are standards to disclose risks.
That was my next question. Yes.
Called the TCFD, the Task Force on Climate Related Risk Disclosure. And so there's a process for quantifying and reporting risks. There isn't standardization as much there, right? Because it's still anecdotal. Like I have this risk, you have that risk. It's apples to pineapples, right? So over time, I think maybe there could be some standardization there, maybe not. But where there can absolutely be standardization is how many missions are you doing and how many missions am I doing? And that's what scope 1, 2, and 3 is. And so I think that is another level of risk that's disclosable, that's knowable, and that certainly can be standardized.
So has the insurance industry tried to standardize these types of risks in any way?
Well, from a dollar standpoint, they are. The number of billion or trillion dollar weather-related events, catastrophes is exponentially growing. Right. And so they're certainly looking at it. But insurance companies are like the next level down from banks on the implications of this SEC rule, right? Because if you're a publicly traded insurance company, your product is your insurance policy. And so you'd have to understand what are the carbon impacts of your insurance decisions. And that's a whole nother level of, how this rule could transform our global economy from that perspective. I mean, an easy way to think about this is if you're a bank is right now, wouldn't you want to know if banks or what banks are financing oil drilling? We don't know. The oil companies aren't self-financing that.
Right.
They're getting money from somebody. They're getting money from banks. So there are banks around the world, banks in this city that are loaning for that every day. And they're looking at it just from a dollars or cents standpoint. Like, is this a good loan or not a bad loan, right? It's a good loan. It's a highly securitized company.
Right.
They're going to pay me the interest. It's a good business transaction decision. So I get that, right? But you overlay, okay, what's the societal impact of that, which is what this SEC rule would do. So if all of a sudden all of that is disclosable, I would think that bank would have just as much interest in finding ways to finance renewable energy as they would oil exploration. And the way you do that is through terms, right? And so I don't think banks would all of a sudden stop loaning to oil companies, but it may just be at a higher premium. And if you want to loan to a renewable developer, it could be at a lower rate. That's the way you'll balance a portfolio.
Interesting. So there's a follow-up question about the risks, the climate risks, from Paul Mandyck. Would like to know if you have other examples besides weather-related risks.
Sure. Are your products using a lot of energy or causing a lot of carbon emissions that could be more highly regulated in the future? So, for example, is your business model all about building gas pumps for automobiles? So if it is, maybe that's a model that's not sustainable for the next 30 years as we think of EV chargers coming on board. So that's another risk, is what's the makeup of your portfolio. Another risk could be, are you risk to regulation? Are you risk to fines? And so those are all the types of disclosables that investors would want to know about.
And so that when you say climate related risks, you mean everything in that pool?
Everything from where are you located to where are your suppliers located to what's your product mix to what is your regulatory profile. That's all in what the climate risk would be.
Interesting. I'm really curious what business schools are thinking about this and teaching the next generation of folks coming up.
That's what I do in my class at the University of Connecticut.
Can you talk about that for a minute?
Yeah, sure. So I teach in the MBA program and I have for 8 years. And my class changes literally every year because this issue is moving so quickly.
Oh, wow.
So I teach I started in January, I teach in the spring term. My last class didn't even have any of the SEC in it because it just happened. And it's so transformative. So business schools, are starting to understand, yes, we need to, find ways to produce people who know how to count money and to run good businesses, but also do it in the context of what's going on in society, and understand how you do all of that and manage climate change at the same time.
So interesting. Do other countries already have regulations similar to this, or is this one a new type of rule on the horizon?
It looks like Europe could finalize a regulation like this before us.
Oh, okay.
In general, the European regulations are ahead of the US as far as transparency. We're starting to see more European governments require net zero standards. So require them of companies that are doing business with the government. In Europe right now, if you are a publicly traded company, you are required to file a sustainability report every year. That's a way to get at this transparency a little bit. That was a baby step. The next step is, okay, we want everybody to report the same information.
Right. And how long ago was that required?
That's been in effect for a few years.
Oh, interesting. Okay. Oh, Paul says, thank you. Those are great examples. So thank you very much.
Paul.
And thanks for your question, Paul. Okay. If mortgage lenders want to know the carbon emissions of real estate, would this mean that average homeowners would have to disclose their greenhouse gases to their bank for a home loan?
I think it would be more at the time of property transaction for a homeowner. So if a bank's going to give you a loan for a mortgage, they want to know what the carbon profile is of that property at that point in time. Or they may say, okay, well, if you want to if you want to change out your HVAC system and boost the efficiency, we'll allow you to roll that into the mortgage at a better term. From a financing standpoint, that could be an outcome of where this goes.
And so the rule that they're considering is for new loans, not current loans?
Well, the rule only requires banks to disclose their emissions, right?
Okay.
Right. That's all we're talking about, right? So banks would have to disclose their emissions. But if you just play the chessboard out a little bit, if all banks disclose their emissions, someone's going to be in position A, B, C, D, E, F, G, right?
Yeah.
The ones in position A are going to attract more investors. If you're in position G, you want to get to position A, right? So what do you do to rebalance the loans you're giving to create less climate emissions? That's when banks are going to start to do things like wanting to know what your emission profile is of your mortgage so they could get a better emission profile in giving you money.
Right. But I think that's what that question was getting to. Like I'm 10 years into my 30-year mortgage, let's just say, all of a sudden, am I going to have to do some new calculations
no,
that I never
I
had
think
to
it
do?
would be, I don't know. The question is we don't know. The way I would imagine it would play out would be at the time of underwriting.
Right. Which made that, right.
Right. But back to why this is important to Urban Green and our stakeholders, when you're talking about commercial real estate, it moves all the time and there's underwriting going on all the time. And so I think this could free up different financing streams for retrofits and local law 97 compliance in a way that we don't see it today. Because now all of a sudden the bank is going to want to know what your local law 97 exposure is when today they don't really care.
Right. Right. Okay. I'm not entirely sure I understand this question, but I think you will. Do you think that this should be integrated into the current ESG framework, or should emissions be considered on their own?
I think the emissions should probably sit on top of the ESG framework. And in other words, it is the standardized way that you can measure all companies, all countries from that matter, right? Is okay, what are your emissions? And so I think that should be its own kind of standardized.
Because it's quantifiable or because it's so important, or both?
Both. Mainly because it's more easily quantifiable in the same unit. It is standardized already from that standpoint.
Okay. So this question, you partially answered this question already, but is there any indication as to whether the SEC will approve this rule? I know they're taking comment now, and when will a decision be made? And I'm going to add, is there anything that you want to ask people? Should we comment on it? Should we support it?
Yeah, so I believe the SEC just extended the comment period. So you go on the SEC website, it's actually pretty good. And there's a great summary of the regulation, and there's the whole regulation if you want to read it in legalese. So yeah, anybody can comment today. I think it's their intention to make a decision this year, but the timing is up to them. And are they going to make this decision? I think they are. The SEC is controlled by presidential appointment. And so, President Biden has his picks on the SEC right now. And so, I think when you look at the politics of this, I think SEC is going to finalize something that looks the way it looks now. Is it going to be the exact same? Maybe not. Is it going to have a little nuance to it? Is it going to be a couple of years later? Who knows? But I think something like this can happen because they have the authority to do it.
Okay. Do you see the social cost of carbon playing into the emissions and risk disclosure? And if so, how?
Yeah, that's a good question. I think this starts to help better quantify the social cost of carbon. The problem with the social cost of carbon right now is there are too many of them, or they're not enough, right? Right. Yeah. So a lot of jurisdictions don't have them at all. A lot of countries don't have them at all. And then some countries have several of them, like which one are you going to pick? And the ones that they have are underestimated. Like I happen to think that the EPA social cost of carbon number probably is a little low. We have a new social cost of carbon in New York City. It's $268 a ton. That's what Local Law 97 is. So I think we need some better uniformity on how we arrive on what the social cost of carbon is. Once we do, then it's just a mathematical formula because you just plug that against what the disclosed climate emissions are.
So I want to go back to RECs we mentioned earlier. So as new technologies are developed and whatnot, are you worried about folks gaming the system or somehow?
Well, ironically, that's what the SEC is all about, is make sure people don't game systems, right? And so I think the proposal is a reaction to the systems already being gamed a little bit, in the sense that I use that term loosely, in the sense that people are disclosing, but not uniformly, and not in an intentional way. It's just like some companies disclose scope 1, some disclose scope 2, some do all 3, some don't, and like you can't figure it out.
Right.
And so this is a kind of a manner
so less gaming as we move forward would be welcome. Okay. Actually, excuse me, to go back to the insurance companies, wouldn't this type of disclosure be welcome by insurance companies? Would make their work easier, and then they can better understand climate risks that they're underwriting?
I would think so. I would think that insurance companies would want to know this. But by the way, my guess is insurance companies already know this. And understand the climate risk associated with what they're doing. So, it would help them from a public standpoint, but my guess is this risk is already being factored in their underwriting.
Okay, this question, in your opinion, is a carbon emission penalty or a carbon credit trading system necessary for this new ESG economy?
Can I have both?
It's your opinion. You can have whatever you want.
I think we're going to need all sorts of different ways to lower carbon emissions personally. And so, we're going to have to look at carrots, we're going to have to look at sticks. But the important point is that we know what we're dealing with and we don't today. We take for granted in New York City that we have benchmarking, right? What this is benchmarking for the economy, right? So we have benchmarking, we understand the building emissions profile in New York, and that's fantastic. Why shouldn't we have that for every company? That's what we're talking about, is extending benchmarking to every publicly traded company.
If this rule does not go through, what do you think would happen next?
Like I said, I think investors are going to demand it anyway. And so I think we'll start to see greater and greater investor pressure on this. And sooner or later, consumers are going to understand this and want to know where's my money how's my money being used when I'm sleeping at night?
So it seems to me that there is going to be, and you mentioned this, some new industry developed to be able to tackle all of this with new kinds of consultants and new jobs. What do you think are some of the new jobs we might be seeing?
Data analysts, climate and carbon data analysts.
So that's what we should say to all the high school grads
Yeah,
this
absolutely.
week, data analysis. Okay.
Data analysis.
Awesome.
Because that's what scope 3 is.
Okay.
You have to get thousands, if not millions, of disparate points of data and channel it in a way that's reportable. And so I really think we'll start to see stronger programs and systems to do that.
I'm going to double down on that question, because are those jobs then jobs, on site in factories and investigating, or are those jobs, culling massive amounts of information and making it, and interpreting it in different ways?
It's both. And I think it's no different than the financial industry today, right? So if you think about the financial industry, in-house in a company, you're going to have a CFO, you're going to have a controller, you're going to have financial planners and accountants, right? Then you have consultants that do that. There are these big firms, like we all know the brand names of them, right? And then you have auditing firms that do that. I think that will be and should be replicated from a climate emission standpoint, where you'll have in-house people who will be responsible for collecting the data and reporting it. They will then be augmented by consultants who will help them do that and give them better ways and how that could be done. And then you'll have another wing that'll be an audit type function that will say, okay, did you do it in the right way according to whatever standard you signed up for tells you to do?
Okay, I like this question. In terms of ways for us to get better at valuing the health benefits of lower carbon, not only for the greenhouse gas reducing emissions, but also fewer toxins, damaging ecosystems and things like that. How do you think that would be calculated? Is it part of the calculations?
I think you could get your way there by understanding what is the carbon emission profile to begin with, right? And it's a conversation we have to have, because the health co-benefits of all of this are often left behind or not calculated or least understood. But it has to start with some baseline data, and that's what this is about. So if you know what the carbon profile is, then you can understand by jurisdiction, and what does that mean by health? What is that doing to the local utility? And what's the carbon intensity of that local utility? And then how much NOx, SOx, PM 2.5 are being emitted in this community? So it all starts with understanding what the base data is. And for me, the base data we need is the carbon profile.
Okay. Do you see any potential unintended consequences from this rule? For example, disinvestment in certain areas or things or properties that might have a negative equity impact?
Yeah, that's a really good question. I think big picture from a financial industry standpoint, it would incentivize loans for lower carbon assets, whether it's energy efficiency, whatever it is. an EV car loan versus a combustion engine car loan. And it would disincentivize things still using carbon.
Right.
And so we would have to think through what the equity implications of that would be.
Yeah, it sounds like there's a lot of variables happening all at the same time. Is there other, writings that you have found to be useful to help you interpret what's going on? I mean, sounds like a sea change.
It is a sea change, and I'm surprised that this isn't being reported more, which is part of the motivation for me to do the Harvard Business Review articles, to try to get this narrative out there so people can be having discussions like we're having right now. So I'm hoping that it'll be reported more. I am starting to see a little bit more in mainstream press. What I'm seeing, though, is company A thinks this is going to be too hard to do and therefore is lobbying against it, when company A isn't thinking through where do they sit in the global implication of all of this, because they may be able to take advantage of it. And so, I would encourage people just to think through the chessboard on this and not just the first move with the pawn, because I think there could be more opportunity than not in the sustainability space to create new financial mechanisms and new capital streams to decarbonize.
I'm going to stop there because I like ending on a positive note. Thank you very much, John. That was really informative and super interesting. And thank you for taking the guest seat on this issue today.
Ellen, thank you for taking the guest host seat.
Anytime. Today's program is a great example of what we do at Urban Green. We take on the biggest challenges with the biggest solutions to have the biggest impact. And we do that through 4 key activities. Do you want to say them, or should I? It sounds so weird not coming from you. We convene, we research, we advocate, and we educate. And if you're not already a member, please check us out and support our work. Thank you for joining us today. We'll see you next time, and stay safe.